Gold and silver prices don't explode for no reason. When they move fast, it's not hype. It's pressure being released. Behind every sharp move in precious metals is a combination of monetary stress, physical shortages, and geopolitical strategy. Today, we're going to break down the real causes behind the explosive moves in gold and silver, and why these moves tend to happen suddenly, not gradually. Part 1. Central banks are telling you something. Let's start with the most important signal: central banks. For decades, central banks sold gold. They trusted paper currencies, bonds, and the US dollar system. That has completely changed. Today, central banks are record net buyers of gold, especially in China, Russia, India, and the Middle East. This matters because central banks don't trade. They accumulate. When a central bank buys gold, it's removing metal from the global market for years, sometimes forever. That quietly tightens supply. Why are they doing this? Because gold is no one else's liability, immune to sanctions, independent of political systems. In other words, gold is becoming strategic money again, not just an investment. And when central banks reposition, markets eventually follow, usually in a rush. Part 2. Supply is not keeping up. Now let's talk about supply and demand, especially for silver. Gold supply is already tight. New mines are harder to find, more expensive to build, and take over a decade to develop. Production is flat or declining. Silver is even more fragile. About 70% of silver is mined as a byproduct of other metals like copper and zinc. That means higher silver prices don't automatically increase supply. At the same time, industrial demand is exploding. Solar panels, electric vehicles, electronics, data centers, and AI infrastructure. Silver is not just money, it's a critical industrial metal. When investment demand shows up on top of industrial demand, there is no buffer. Shortages appear fast and prices reprice violently. Part 3. The paper market versus physical reality. Here's where things get dangerous and explosive. Most gold and silver trading happens in paper markets: futures contracts, ETFs, and derivatives. But the amount of paper gold and silver traded is many times larger than the actual physical metal available. As long as people trust paper claims, the system holds. But when confidence cracks, even slightly, investors rush to convert paper promises into physical metal. That's when prices gap higher. Gold usually moves first because it's the primary monetary metal. Silver follows later. But when it moves, it tends to outperform violently. This is why silver explosions look sudden and chaotic. The market is thin, leveraged, and confidence-based. Part 4. Financial warfare is the catalyst. Now we get to the accelerant: financial warfare. In recent years, we've seen foreign reserves frozen, currencies weaponized, trade settlement restricted, sanctions used as policy tools. This changed everything. Countries realized that reserves are no longer neutral. If assets can be frozen, they're not truly safe. Gold can't be sanctioned, silver can't be turned off. As a result, nations are diversifying away from the dollar, experimenting with alternative trade systems, increasing gold reserves as insurance. These shifts don't show up slowly in prices. They show up as step function moves, sudden repricing events. Part 5. Why the move feels sudden. Gold and silver don't rise smoothly because the pressure builds invisibly. Prices are held back by derivatives, market structure, short-term narratives. But when trust breaks, whether in currencies, bonds, or geopolitical stability, the release is fast. Gold signals loss of confidence, silver signals scarcity. Together, they're telling you the same story. The global financial system is under stress. Gold and silver don't explode because of headlines. Headlines appear after the move. The real causes are central banks preparing for a new monetary reality, supply that can't respond quickly, paper markets colliding with physical limits, and a world where money itself has become a weapon. When those forces align, price doesn't ask permission.